A shelf registration statement is often referred to as a short form registration statement. And it's a type of registration statement that an issuer can use to register for sale publicly any combination of securities, common stock, preferred stock, debt securities, or any other securities that it can think of for sale at some future time. So when an issuer registers securities on a shelf, it doesn't have to have a precise offering contemplated. Those securities are going to be registered and the shelf is going to be available anytime that the issuer wants to do a takedown off of a shelf. I think that the principal benefit of a shelf registration statement for an issuer is that it provides the greatest possible flexibility. We're living through challenging times. The markets are really volatile. Most issuers need to be very mindful about their capital raising needs, and they probably want to be very opportunistic and very thoughtful about when and how they approach their capital raising. So if an issuer has a shelf and it's effective, an issuer then has maximum advantage in terms of when it can decide to do a deal. By contrast, if an issuer didn't have a shelf up and ready, the issuer would, when it decided to do a deal, have to go through the registration process with the SEC. The SEC might review the registration statement, and at that point, the issuer would have to be subject to a time delay potentially while it got through the SEC comments. Issuers can choose to approach the shelf process in a number of different ways. So sometimes issuers will specify upfront the kinds of securities that they want to register for sale. Other times, depending on the issuer's size and sophistication, if it's a WIXI, for example, it can choose to add other kinds of securities later. An issuer generally will either specify a share amount that it's going to issue, or it'll specify a dollar amount. So for example, an issuer can say that it's going to register up to $500 million of securities and then leave unspecified how it's going to divvy up that amount. How much will be common, how much will be preferred. For a long time, issuers, particularly issuers in certain industries, had some trepidation about filing a shelf. And the fear there was that if an issuer filed a shelf, there would be some perception of a market overhang. And by market overhang, really we mean that investors would look and be fearful that an issuer would essentially, in one fell swoop, do a very large issuance of securities and that issuance might be dilutive. I think with the passage of time and the real popularity of shelves, the mindset has changed a great deal. So now almost every company that can file a shelf files a shelf, and consequently there's no perception and no negative association with the filing of the shelf. The market, I think, is sophisticated enough to understand that an issuer has to prepare, and having a shelf up and ready to go is a key step. For securities law purposes, the SEC has been really very clear with its guidance and has said that merely by having a shelf up, an issuer isn't considered to be in distribution. So why is that important? An issuer has to consider its pattern of communications while it's doing a securities distribution or conducting an offering. The SEC has said that an issuer is in distribution when it's reached an agreement with an underwriter or placement agent to actually do a specific deal. So it's the takedown off of a shelf that's considered the distribution, not just having the shelf there. Once you have a shelf effective, you're really only limited by your imagination. An issuer can use a shelf for the most traditional underwritten public offering, but an issuer can also use a shelf for a hybrid offering methodology. For example, an issuer can do a takedown off of a shelf that's a registered direct, an agented transaction. An issuer can use a shelf to set up an at-the-market offering program or ATM program, which has become a very popular offering methodology. An issuer can also use a shelf to set up a continuous offering program, like a medium-term note program, an MTN, which is very popular for the very largest issuers who have investment-grade debt securities. In order to file a shelf, the preconditions are pretty straightforward. First, the issuer has to have been a reporting company for a full 12-month period. And during that 12-month period, the issuer has to have made all of its SEC filings on a timely basis and can't have defaulted on any of its payment obligations. So no defaults on the payment of preferred dividends, credit agreements, or other obligations. And then there are really two different kinds of shelves. There are the regular shelves for issuers that have a market cap of 75 million or more. And then there are the smaller shelves for companies that don't meet that $75 million threshold. The shelf process has undergone some significant changes in the last few years. The first group of important changes to keep in mind were those that came about as a result of securities offering reform in 2005. And what the SEC did there is to simplify the shelf process a great deal. During that reform, the SEC created an automatic shelf, and that automatic shelf is for the largest and best known companies, those that are well-known seasoned issuers, or WICSEs. So WICSEs have the opportunity to file a shelf that's automatically declared effective. It's not subject to SEC review. At the same time, during securities offering reform, the SEC also clarified that a shelf is considered valid or has a useful life of 3 years. So once a company files a shelf, it knows that it can use that shelf for up to 3 years. And there were a number of other kind of practical changes that came about as a result of securities offering reform in 2005. More recently, as I alluded to, in 2007, the SEC again made some changes affecting shelves. And realizing that capital formation is very important, particularly for smaller public companies, what the SEC did was create this new category of shelves. So issuers that are below the 75 million in market cap, but that meet the other shelf requirements, they've been public for a year, their securities are listed on a national securities exchange, those issuers can put up a shelf and in any 12-month period sell securities representing up to 1/3 of their public float. So for a lot of our clients who are smaller public companies, this was a really meaningful change. It meant that they were now on a more equal playing field. They had access to doing registered direct transactions and to doing underwritten takedowns, which were really not opportunities that they had had before. So prior to that period, a lot of smaller companies were limited to using pipe transactions as their principal means of capital raising. In order to get ready to file a shelf, an issuer has to seek appropriate board authorizations. So gather its board and be authorized to prepare and file a registration statement. Of course, work with counsel to put together a registration statement. There are a number of exhibits that are usually filed with a shelf registration statement. So usually to, again, be well positioned and take maximum advantage of the benefits of a shelf, an issuer generally will prepare a form underwriting agreement, a form indenture that it would use for debt securities, and file all of these exhibits when it makes the initial shelf filing. In order to file a shelf, an issuer also has to have a consent from its independent accountants. So in addition to working with counsel, they'll also be working with the accountants who'll be providing comments and providing the consent that's included in the registration statement. There are really two kinds of registration statements or shelf registration statements that people refer to. There's a primary registration statement, which is for newly issued shares that are being offered by the company. And then there's a secondary, or often referred to as a resale shelf registration statement. A secondary registration statement will include shares that are already issued and that are in the hands of selling stockholders. The qualifications or eligibility criteria that I talked about earlier is for a primary shelf. For a resale registration statement, an issuer needn't meet that $75 million capitalization criteria. So almost any issuer can file a shelf for resale purposes. Going back and focusing a little bit on WKSIs and WKSI shelves. The addition of, or the concept of, an automatically effective shelf registration statement is a really important development because it allows the largest public companies to be able to put up a registration statement very quickly and access the market very promptly. Also, a WKSI that's using an automatic shelf registration statement has much greater flexibility than does your average issuer. A WKSI can exclude or omit different types of securities and add those subsequent to the registration statement having been filed and become effective. A WKSI also has the opportunity to omit the names of selling stockholders and add a selling stockholder component to a registration statement after the registration statement's been filed. Smaller public companies that are capable of meeting the eligibility criteria for filing a shelf should really attempt to do so and to have a shelf up and effective as promptly as they can. And the reason is that having the shelf offers many more opportunities. While PIPE transactions are a very attractive capital raising alternative, it's often the case that an issuer will get more favorable pricing if it's able to offer investors fully registered securities. There's no illiquidity discount associated with those securities. So consequently, a registered direct may offer better pricing for a smaller public company than a PIPE would. Likewise, a smaller public company may be able to do a takedown off of its shelf to meet specific obligations that it has before it. For example, for issuances to strategic partners, to joint venture partners. A shelf registration statement's effective for a 3-year period. Assuming that the company has not taken full use of the shelf, what it can do is file a new shelf and it can roll forward any unused amounts. So the company is not going to lose the fees that it paid, the registration fees it paid when it first filed, and effectively it can merge the two shelves. Companies need to be watchful of when that 3-year date is up, because they'll want probably ahead of that deadline approaching to have a new shelf on file so that they don't have a gap where, some period of time during which they don't have access to a shelf. Another very useful change that the SEC implemented is that if a company is approaching that 3-year time limit and it files a new shelf, the SEC will permit the company to continue to use the old shelf in the interim if the new shelf is being reviewed by the SEC. In terms of our best advice to clients, it's always to be prepared and to be well positioned to take maximum advantage of market windows. And the best way to do that is by having a shelf up, by keeping a shelf current, and to make sure that all of its SEC filings are submitted in a timely way so that the company doesn't become ineligible to use a shelf registration statement.